Yeah, good evening, everyone, once again. My name is Adejuwan, and I'm one of your tutors for performance management. Myself and Mr. Shiwaju are the two compatible partners that will be taking you performance management during the course of these diets. On Tuesday, you had Mr. Ashwaju. So every Friday, I'll be the one that will be taking you performance management. Okay? So without wasting more time, we are going to be talking more as we proceed. But for now, let's get down to business. All right. So during the course of these diets, I'll be taking you the scope of my class under performance management. I'll be the one to take you operating statements. Operating statement will take us for like, if I need maximum of 4 hours, we should be done. It's very straightforward and also fundamental to some topics under performance management, particularly when we get to relevant costing. We are going to need the techniques of marginal costing. Also, we are going to need the concept of marginal costing under short-term decisions, optimal product mix, linear programming, cost volume profit analysis, and even in pricing decision, you need the concept of marginal costing. So it is foundational to some of the topics in performance management. So give and take between today and in our next class, we are going to complete operating statement. So once we are done with that, we dive in straight to discussing relevant costs for decision making. It's also a very important topic in performance management. All right, very regular topic in ICAN exam. After which we are going to move to dissecting short-term decisions. Under the short-term decisions, we are going to look at several ways in which you can apply marginal costing techniques to aid managerial decisions. So we are going to look at deleting of a segment. We look at special order, acceptance. We are going to look at make or buy decisions, okay, and some other areas of applying marginal costing techniques. Once we are done with that, we move to discussing optimal product mix decision. This is where you have key limiting factor. All right. Once we, in the under short-term decision, under relevant cost, for example, we are going to need like 3 periods for us to be able to do justice, to fully do justice to relevant costing. It's very straightforward, but it is principle-based. If you don't understand the logic and the principle, you will struggle to solve question correctly. All right. So that's what we are going to be discussing under relevant costing. What's ordinarily within a period or 1.5 period we should be done. But because usually I like to solve as many questions, as many past questions as possible, different scenarios. That's why it will take us for like 3 periods. Okay. Then the short-term decision also, which will take us for like 3 periods as well. Okay, because each scenario areas under short-term decisions, we are going to solve at least 2 questions under each. And like I said, we are going to look at deleting of a segment. After the introduction, we look at deleting of a segment, we solve 2 questions. We look at special order, we also solve 2 questions. We look at make or buy, we solve minimum of 2 questions. So all of these things takes time. And that's why we are saying that at least we need minimum of 3 periods. Okay. Now, optimal product mix. In optimal product mix, we need minimum of 2 periods or 2.5 periods, because we are going to solve like 4 different scenario questions. Okay, 4 scenario past questions, because we are going to look at optimal mix, regular question under optimal mix. We are going to look at a question that involves minimum allocation. We are going to look at a question that optimal mix question involving make or buy. Then we're also going to look at optimal mix involving special order. So that's why it will take us for like 2.5 periods for us to be able to fully do justice to the topic. Then once we are done with optimal mix decision, we then move to linear programming. So optimal mix and linear programming, they are like brothers. They are 5 and 6. Okay, they are 5 and 6. The optimal product mix is used when there's only one constraint, whereas linear programming is used when there are multiple constraints. Okay, so give and take, I need 2 periods for me to be able to complete linear programming. I need 2 periods for us to be able to do that. All right, then after which we move to cost volume profit analysis, which is the same thing as a break-even analysis. In this, I need like 2.5 periods also, because that's about 3 questions under single products, break-even under single products. All right. Then for multi-product break-even, we are going to solve like 2 to 3 illustration as well. So, and that's why that 2 periods may not be sufficient, but again, minimum of 2. All right. Then risk and uncertainty. Under risk and uncertainty, we are going to spend like 3 periods. Like I mentioned, for those of you that are offering financial management, so we have risk and uncertainty under FM and the PM, as you can see. Therefore, when we are going to do risk and uncertainty, I'm going to merge both FM and PM students together. The scope of risk and uncertainty under the performance management is more than the financial management. However, when we get there, you will see. Okay, and then finally, I will be the one to take you learning curve theory. Okay, I'll be the one to take you learning curve theory. I need just a period for learning curve. It's very straightforward and also very interesting. Okay. All right. So these are the areas that I will be taking you for this for the next 3 to 4 months. Okay, for us to be able to fully do justice to the syllabus of performance management. Every other areas will be treated by Mr. Ashewaju. Okay. However, there are some self-study areas of the syllabus. All right. So you are the one that will read about the introduction to strategic financial, strategic management. They are purely theoretical. All these areas are purely theoretical. So the calculation you have under entity performance management. So Mr. Ashwaju will take you under divisional performance evaluation. Okay. So then strategic performance measurement and analysis. This is more like a model. So it's purely theoretical. All right. So visibility, project feasibility and initiation. This is an IT aspect of the syllabus. So you read all of those by yourself. You can see it's less than it's about 15 pages. So just go through them, summarize. You can also go to the ICAN study pack. Please, that reminds me. As you begin your ICAN journey, it is essential for you to take your study very seriously. As you begin to read, please, you are going to combine your study material, okay, this learning material with other valuable materials like ICAN study pack. All right, ICAN study pack is soft copy, just like this one. Okay, so that, because there are times ICAN may lift, especially the IT aspect of the syllabus, ICAN can lift question from there. And if you are familiar with the note already, if you are familiar with the material, so it will be easier for you to quickly respond to the question and solve it as expected. You can't be preparing for ICAN. You don't study the ICAN study pack. You don't attend classes as expected, and then you don't research, because you can't base your study on the classwork alone. There's no way your lecturer is going to cover the entire syllabus 100%. All right, and that's why we are referring you all these theoretical aspects of the syllabus. Okay, you need to read them by yourself and form a note. Develop your note on them, a summarized note, so that going forward, you don't need to go back to ICAN study pack again. What you are going to be reading will be your summarized notes, and there's a key point. All those theoretical aspects of the syllabus, you don't need, examiner is not asking you for story. All right, tell me, demonstrate that you have the understanding of what is being of the requirements. That's what the examiner is asking you. Please do well to take your study very seriously. Okay. Let's leave story for now. Let's dive in straight to the main discussion for the day. So the first topic we are going to treat today will be operating statements. It will be operating statements. I will switch. You can open to the material at your end. If you are using, whether you are using your phone to watch, to listen to this class, or you are using a laptop, just click on the topic and it will take you directly to, there's a link attached to it, so it will take you directly to the page. All right. However, I want to switch to a Word document that I will be using to demonstrate for you. So for some of you that had my class on Monday for financial management, I've still not been able to resolve the issue with my pen. Until then, I'll be using Word document to undertake this class. Okay? All right then. So like I said, open to the material at your end, and then let's follow through together. Okay? All right. Let me switch to Word documents. So at your hand, you may be jotting one or two things, or maybe when you finally have the video, you can watch again and then you form your notes. But it's important for you to always have a jot, of the class, so that you don't miss anything. Okay. Let me increase it more. That's okay. All right then. So what do you understand by operating statements? What is operating statements? Simply put, operating statement is a statement that shows the operating performance of an organization for a specified period. Festus, you are disrupting my class. You guys should be careful. You know, we are just starting. You are just meeting me. We are going to quarrel in class, please. You have to avoid that. It distracts me. Any background noise usually distracts me. Please avoid it. Always mute yourself. If you want to speak to me, if you want to ask me any question, just raise your hand. I will allow you to talk. Thank you. Moses, don't repeat it next time. Okay. So like I was trying to say, operating statements is a statement that shows the operating performance of an organization at a specified period, usually a year. It could be a year, half a year. It could be quarterly or monthly. All right. It is also known as income statements. Basically, there are mainly two methods of preparing or presenting income statements, including number one, marginal costing technique. Number two, absorption costing technique. Bob Manuel, you guys are looking for my trouble. It's because we are just starting. That's why I'm very cool with you. Don't repeat it next time. Please. I've said my own. If you make the same mistake again, I will remove you from the class. You will only watch the video. You use that one to learn lesson. The next time I'm very sure you will not repeat it. Look at now, I've wasted like 2 minutes because of disruption.
Operating statement.
Are you guys a baby?
Huh?
Why are you making noise in my class?
Nami?
Why are you guys disturbing us now?
Ah. Sorry, let's move on. So like I was trying to say, there are two methods of presenting income statements. The first one is marginal costing concepts. The number two is absorption costing technique. Anytime you want to present, examiner can ask you to prepare operating statement or income statements. If examiner does not ask you to use a particular method, you should know that you are going to present the statement using both marginal and absorption costing. But if examiner is specific, that means it's very straightforward. Just go ahead, prepare your income statement using the two techniques. You are good to go. All right. So let's discuss each method one after the other. The first one we are going to discuss will be marginal costing technique. What is marginal costing technique? What are the key points you need to know as far as marginal costing technique is concerned? Is there any format that you can use to prepare your income statement? All of these are what we are going to discuss as far as marginal costing is concerned. We do the same thing for assumption costing. All right. Once we are done with assumption costing, then I will also demonstrate for you how to calculate closing stock and how to value closing stocks. We are going to learn about the concept of overhead absorption costing and how to treat under and over absorption. Finally, we discuss reconciliation statement. For majority of you that are already on the group, I've already shown you the learning outcome for this topic. All right. So let's begin with discussion around marginal costing concepts. Marginal costing is a technique that charges the total variable cost of production, including direct material, direct labor, direct expenses, and variable production overhead to the unit cost of a product. I will repeat again. Marginal costing technique is a concept that charges total variable cost of production to the unit cost of a product. When you talk about total variable cost of production, it simply means direct material, direct labor, direct expenses, and variable production overhead. Those are the forms of variable cost. For example, let's say I'm a manufacturer of markers. I produce and sell markers, whiteboard markers. So if I want to determine how much it costs me to produce one marker, using marginal costing approach, I will only consider the costs that are variable. I will only consider the total variable cost of production. Okay? That is, I will consider direct material, direct labor, direct expenses, and variable production overhead. Those are the costs I will charge as the cost unit of that marker. So that is the concept of marginal costing technique. It is an accounting system. Marginal costing is an accounting system whereby the period cost incurred are written off fully from the aggregate contribution. I repeat, marginal costing technique is an accounting system whereby the period cost incurred are written off fully from the aggregate contribution. What do we mean by that? What we are simply saying is that as far as marginal costing is concerned, all the costs that are fixed in nature, for example, fixed production overhead, any other fees and any other fixed costs, like fixed marketing expenses, fixed selling expenses, fixed administration costs, any costs that are fixed in nature will be deducted from the contribution margin. That's what we simply means that it will be period cost incurred will be written off. When you say written off, it means deduct. So we are going to deduct period cost from the aggregate contribution. So marginal costing technique is designed principally, it's a concept designed principally to aid managerial decision because it allows management to focus on the areas of the business that are strategic to achieving the organization's objective. All right. It allows management to focus, all right, on the areas of the business that are critical to achieving the organization's objective. That is what marginal costing technique does. Anytime you want to talk about decision making, anytime an examiner is asking you anything about decision making, then one concept that should come to your mind is marginal costing technique, because we use marginal costing technique for decision making. I believe that is clear. You don't use absorption costing. It is purely marginal costing for decision making. Okay. So if that is that, let's move on to discussing the areas or the key points that you need to know when you are presenting income statements using the marginal costing approach. That reminds me, please, if I'm too fast for your liking, always call my attention because that's the way I talk. All right. So if I'm too fast, let me know. You need to ask questions. Anything that is not clear to you, you must ask questions. Remember, this is online. I can't see your face. I can't read your mood. You can also not see my face. So, and that's why it becomes challenging. And that's why we're encouraging you. You must ask questions. If anything is being taught and you don't understand, please, nobody knows. Nobody is seeing your face where you are. Nobody knows you among the people, among your colleagues in the class currently. And that's why you have to ask questions. It's very important. Don't leave the class without you understanding what is being taught. Otherwise, it will become a burden on you. Of course, that doesn't mean that you cannot relate with your lecturer. You can always chat privately with your lecturer to seek for clarification. You can always chat in the group, in the subject group, to seek for any clarification. But while you are in the class, you have 100% rights on the lecturer to give you clarification on what is unclear to you. Please. Okay, then. Let's talk about the characteristics of marginal costing technique. What are the things you need to look out for? Or what are the things you need to consider when you are presenting income statements using the marginal costing approach? The first point when you are presenting income statements using marginal costing approach, the first point is that opening and closing stocks are valued at total variable cost per unit, okay? Opening and closing stocks are valued at total variable cost per unit. That's the first point you need to consider, all right? Anytime you want to compute, okay? Anytime you want to compute or you want to prepare your income statement using marginal costing approach, immediately after your sales, you are going to have production cost. Under the production cost, the first item you are going to have there is the opening stock. Therefore, when you want to value the opening stock, you are expected to value opening stock using total variable cost per unit. Let's say, for example, okay, let's say, for example, let me put it here so that you understand better. Let me put it here. Let's say, for example, all right, we are given opening stock. We are given opening stock of 5,000 units for simplicity. 5,000 units, okay? And then in the question, you are given direct material cost. Direct material to be, let's say, 5 naira. Direct labor to be, let's say, 3 naira. You're also given direct expenses. Let's say this is 2 naira, okay? You are given variable production overhead. Like I told you, for some of you that are doing FM, financial management, you don't need to cram anything. You must understand the basics. It's only when you have the in-depth knowledge of the concepts, then you'll be able to express yourself freely, okay? If I can scatter the question for you, then, of course, since you understand the concept, you'll be able to come out clean, all right? Let's say variable cost is also 2 naira, and we're given fixed production overhead to be, what do we have there? 5, 10, so to be 3 naira. So let's say we have total cost now. Total cost per unit. Okay. Total cost per unit is equal to 15 naira. All right. So let's say these are the information we have in the question. All right. And then we want to determine, we want to value opening stock. All right. Let me change the font of my pen to blue so that it will be different from what you have in the material. so that we know that this an addition. Okay, so if I now want to value my opening stock, remember we said that opening and closing stocks are valued at total variable cost per unit. So what I will do is to add up all the variable costs per unit: direct material, direct labor, direct expenses, and variable overhead. I will add the four of them together, which is 12 naira. So that's the total variable cost per unit. Therefore, I would then say opening stock equal to, I will carry my calculator. I have opening stock in unit to be 5,000 units. This is 5,000 units, then multiply by total variable cost per unit, which is 12 naira. So this should give me around the 60,000 naira. So this will then be the value of my opening stock. So that's why we are saying that opening and closing stocks are valued at total variable cost per unit. All you need to do is to just add up total variable cost per unit, then multiply with the units, with the opening stock in units. So that will give you the value of the opening stock. So that's the first point you need to know when you are preparing an income statement using the marginal costing approach. When we get to closing stock, I will explain how we are going to treat closing stock separately. All right. The second point you need to know as far as marginal costing technique is concerned is that fixed production overhead is not part of production cost. I repeat, fixed production overhead is not part of production cost. I think it's not part of the thing you have here. So let me just write it down for you. As part of the bullet points. Fixed production overhead is not part of production cost. Rather, production costs. Rather, it should be written off fully. It should be written off fully from the aggregate contribution. Okay, so that's what you need to do as far as fixed production overhead is concerned. So when you are presenting your income statement, you don't include fixed production overhead as part of your production cost. All right, it's not part. Fixed production overhead is not part of production cost. So when I'm explaining the formats, I will show you, I will refer you to that. Okay, rather, the fixed production overhead should be written off fully. Okay, it's already here. It's written off fully from the aggregate contribution. All right. So that it doesn't look like a repetition. I know what to do. All right. So that's point number 2. Point number 3 is that fixed production overhead will remain constant. Okay. Fixed production overhead will remain constant. Or let me put it this way. Fixed production overhead is a cost. Is a cost that have no sympathy. That have no sympathy for activity level. That is irrespective of the production volume. That is irrespective of the production volume or activity level. Fixed costs. Fixed costs will not change. Fixed costs will not change. Let me reframe this one. Fixed costs will not change. That is, it will remain constant. All right. So under marginal costing approach, fixed costs will remain constant. It will not change. It will be the same amount. Why? Because it is based on the budgeted output or normal capacity. Because, let me put it down. It is based on budgeted output. It is based on budgeted output or normal capacity. It is based on budgeted output or normal capacity. And it can be the fixed production overhead absorption rates. Okay, I will come back to that one later. Let me just continue with this. Then the third point or the fourth point you need to consider is that fixed marginal costing technique. Let me put it down. I'm not sure is there. Yeah, let me add it. Marginal costing technique marginal costing concepts uses contribution, unlike absorption costing. Unlike absorption costing that uses gross profits. So examiner can ask you to explain the features of marginal costing and absorption costing. That's what I'm trying to put up all of this. Okay, so marginal costing concept uses contribution margin, unlike absorption costing that uses the gross profit. So when you are presenting your income statement using marginal costing approach, immediately when you deduct the cost of goods sold from the sales value, you are going to have contribution margin. From the contribution margin, you are expected to deduct the period cost. So, but under absorption costing, the difference between the cost of goods sold and then the sales value is called gross profits. All right. So that's what I'm trying to explain here. Okay. Then number last. Under marginal costing approach, absorption costing is not considered. Okay. Overhead assumption is not considered. I repeat, under marginal costing technique, overhead absorption is not considered. That is, under or over absorbed overhead is not considered. It is only under absorption costing method that you consider overhead absorption. Okay, so these are the basic features of marginal costing technique. But the primary point under marginal costing is that marginal costing concepts is a technique that is designed principally to support managerial decision. We use marginal costing technique to aid managerial decision. So anytime you want to talk about decision making, you are going to need the knowledge of the concept of marginal costing technique. So these are the basic things you need to know as for the features of marginal costing. Then let's talk about the formats of marginal costing technique. Please, like I said, anytime if you need any clarification, always raise your hand. I will allow you to talk. And if I'm too fast, please call my attention so that I can slow down. You must understand it. Don't cram it. Okay. So this is the format you are expected to use anytime you want to present income statements. The first item on the format, is sales value. Okay, the first item is sales value. How do you calculate your sales? You go to the question, you identify the units sold, then you multiply with selling price. Units sold multiplied by selling price will give you the sales value. Then you come and post it on the credit side like this. After that, immediately after sales value, you need to consider production cost. So remember the definition of marginal costing technique. We said marginal costing technique is a concept that charges total variable cost to the unit cost of a product. Okay, it's a concept that charges total variable cost, including direct material, direct labor, direct expenses, and variable production overhead to the unit cost of a product. So you want to determine the production cost. In doing this, the first item you are going to consider will be your opening stock. Earlier on, I demonstrated for you how to calculate opening stock. So you go to the question. If you are given opening stock in units, you then go and add up direct material, direct labor, direct expenses, and variable production overhead per unit. You add all of them together. You then multiply with the opening stock in unit. So that will give you the value of the opening stock. You come and post. Every other cost under the production cost, it will be based on actual units produced. Every other cost will be based on actual units produced. You then go to the particular period. All right, you go to the period because usually when you have this kind of when you have this topic in a question, examiner will never give to you only one period. Minimum is 2 periods. And it usually takes time, even though it's very simple and straightforward, it takes time because you are going to have more than 2 periods and you are going to do the 2 techniques. So it will take time. It will take time. Now, to calculate the total material cost, if you want to determine total material cost, you are going to pick the direct material cost per unit. You multiply with the actual unit produced. So you come and post. Do the same thing for direct labor cost. Direct labor cost per unit multiplied by actual unit produced for the period. You come and post. The same thing with direct expenses. Direct expenses per unit multiplied by the actual unit produced. You post. You do the same thing for variable overhead, variable production overhead. Variable production overhead per unit multiplied by actual unit produced for the period. You then add up everything together. That will give you the cost of goods available for sales. When you had opening stock, direct material cost, direct labor cost, direct expenses, variable production overheads, when you add them together, it will give you cost of goods available for sales. Now, this is total cost incurred for the goods that you want to sell to generate these sales. For the company to be able to generate these sales, your total cost, the total production cost of the goods that you want to sell is the cost of goods available for sales that you have here. However, part of the actual units produced may still remain unsold. There may be closing stocks. Therefore, before you deduct cost of goods sold from the sales value, you need to first of all deduct closing stock from the cost of goods available for sales. Therefore, you need to go and work out your closing stocks. I will show you later on how to calculate closing stock. So you calculate your closing stock in units, you then multiply with total variable cost per unit, whatever it is, you deduct from the COGS, then you have your cost of goods sold. Ordinarily, we are supposed to deduct this cost of goods sold from the sales value for us to have contribution margin. But you cannot do that because there are some costs that are variable but not related to production. Therefore, you need to add variable non-production cost to the cost of goods sold. The total you then deduct from the sales value. I repeat, immediately after cost of goods sold, you need to consider variable non-production costs. You consider variable non-production costs. So to do this, you then go back to the question to go and check if you are given selling and distribution expenses you had. If you are given variable admin expenses you had, any other variable costs that you are given in the question, but not related to production, you have to add it to the cost of goods sold. When you add it to the cost of goods sold, it will give you this total. You then deduct the total from revenue, from sales value. So it will give you the contribution margin. So this is the contribution margin I was telling you the other time, that marginal costing approach uses contribution margin, unlike absorption costing that uses the gross profit. So this is one of the features of marginal costing technique. I also mentioned to you earlier that marginal costing technique is an accounting system whereby the period costs incurred are written off fully from the aggregate contribution. So what this simply means is that immediately after contribution margin, the next thing you are going to do is to consider your period cost. Okay, you have to deduct period cost from your contribution margin. Under the period cost, any costs that are fixed in nature, like fixed production overhead, okay, fixed selling and distribution expenses, fixed admin expenses, any fixed costs that you have in the question, you add them together, then you deduct from the contribution margin. Okay, you deduct it from the contribution margin. This will give you profit before tax. That will give you profit before tax. So immediately after profit before tax, you must adjust for tax. So you then go to the question to go and check if you are given company tax rates. If you are given company tax rates, then you multiply the company tax rates with the profit before tax. Whatever you have is the tax that the company will pay from the income for the period. Okay, so the difference between profit before tax and the income tax will represent your net profit or loss. That will represent net profit or loss. So this is what you need to do as far as marginal costing technique is concerned. This is the format that you are going to use anytime you want to present income statement using marginal costing approach. Okay. So that's that as per marginal costing. Let me know if you have any question for me under this so that we can move to absorption costing method. So like I said, always raise your hand. If anything is not clear, I'm here to assist you. Okay? All right then. Yes, Nancy, talk to me.
You've not told us how to get the closing stock.
I said I will tell you later. So once we are done with absorption costing, the next thing we are going to discuss is how to estimate closing stock. All right, I will show you later on. All right. So let me check messages. All right. How is the concept format different from profit or loss account? Yeah, of course, it's different from a profit or loss account. This one is for management reporting purposes. It's for internal. All right. Unlike profit or loss account, that is for publication. So this one is different from published account. This is for management consumption. All right, Shola. So let's talk about absorption costing method. Absorption costing method is a method that charges the total cost of production, including variable costs and fixed production overhead to the unit cost of a product. Okay, I repeat, assumption costing method is a method that charge the total variable costs, like direct material, direct labor, direct expenses, and variable production overhead, including fixed production overhead, to the unit cost of a product. It is also known as full costing method or total costing method. Okay, it's also known as full costing or total costing method. So anytime you want to present your income statement using assumption costing method, you are expected to charge the total cost of production to the unit cost of a product. Both the variable and fixed costs should be included in the unit cost of the product. That's simply what we are trying to say here. All right. So let's move on. Now, the assumption costing method is a method that relies heavily on the generally accepted accounting principle for external reporting purposes. I repeat, assumption costing method is a technique that relies heavily on the generally accepted accounting principle for external reporting purposes. The assumption costing method is similar to the normal profit or loss accounts, okay? It's similar to the normal profit or loss account, and it's not used for decision making. You don't use assumption costing for decision making. It is only marginal costing technique that is used for decision making. Now, what are the key points you need to consider when you are presenting income statement using assumption costing method? The first point is that opening and closing stocks are valued at total cost per unit. You remember the other time when I was doing the explanation under marginal costing, whereby I gave you opening stock in units of 5,000, then I give you the cost per unit, making 15 naira in total. That total cost of 15 naira is what you are, when you want to value your opening stock, you then multiply the 15 naira with the 5,000 units. So that will give you 75,000 naira. So that will be the value of your opening stock. So anytime you want to anytime you are using assumption costing method for the purpose of presenting income statement, your opening and closing stocks should be valued at total cost per unit. The second point you need to consider is that fixed cost or fixed production overhead is part of production cost. I repeat, under assumption costing method, fixed production overhead is part of production cost. And it will vary depending on the activity level. Let me put it down for you. Let me include it in my explanation here. Okay. Let me add it into this. I said fixed production overhead is part of production costs in determining unit cost of a product. Okay. And let me use a different font color so that it will be different. And it will vary depending on the activity level. This means that the higher the production volume or activity level, the higher the fixed production overhead that will be incurred. overhead that will be incurred. Okay, so that's simply that. Oh, I wrote production twice. So that's what you are going to do as far as absorption costing method is concerned. Okay, as far as absorption costing method is concerned, your fixed production overhead will remain, will change. Okay, it will change depending on the activity level. Let me demonstrate this for you. Okay, let me before that. In this case, fixed production overhead is calculated as number of units produced multiplied by the fixed overhead absorption rate. Okay, anytime you want to, if you are not given fixed production overhead per unit, just go ahead and calculate your fixed overhead absorption rate. All right, so you then multiply that with the actual unit produced. Now, what am I trying to say here? That the fixed production overhead will vary depending on the activity level. Let's say, for example, okay, for example, we are given production volume, okay, actual unit produced or actual production. Let's say we have 3 actual production. Let me put it this way. Let me use a table. Let me use a table. Okay. Let me use for 3 years. All right. Let's say we have, what's wrong with you? 2023, 2024, 2025. Okay, this is the year. Then actual production, actual units produced for the periods. Let's say in 2023, the company produced 5,000 units. In 2024, the company produced 6,000 units. In 2025, the company produced 2,000. Okay, 2,000 units. Let's say this is the actual unit produced. All right. Therefore, if I now want to determine my fixed production overhead, like I mentioned to you, I said that fixed production overhead is part of production cost in determining the unit cost of a product, and it will vary depending on the activity level. That is, the higher the production volume, the higher the fixed production overhead that will be incurred. Of course, the fixed production cost, you are supposed to multiply with, in calculating the fixed production cost, you are supposed to multiply the fixed overhead absorption rates with the actual unit produced. Now, so what I'm trying to say here is that these are the actual unit produced for this period. If I now want to determine my production cost, for example, okay, let me add additional column. If I now want to determine my production cost, fixed production, let me call it fixed production overhead. Fixed production overhead. Let's say the fixed production absorption rate, the fixed overhead absorption rate is 3 naira per unit. It's 3 naira per unit. So this is simple information we are given in the question. Let me adjust this. All right. Now, if I now want to determine my fixed production overhead, which is the basis of this explanation, what are you supposed to do? Very simple. You just multiply your fixed overhead absorption rates with the actual unit produced. So 3 multiplied by 5,000 will give us 15,000 naira. In 2023, the fixed cost incurred is 15,000 naira. In 2024, this will be 18,000 naira. In 2025, 3 naira multiplied by 2,000 will give us 6,000. Now, in my explanation, I said that your fixed production overhead will vary. It will change depending on the activity level. You will notice that the more we produce, the more the fixed production overhead that will be incurred. So that is what I was trying to explain here, that the fixed production overhead will vary depending on the activity level. The more you produce, the higher your production volume, the actual units produced, the higher the fixed production overhead that will be incurred. So that's the explanation of that. I believe that is clear. Then point number 3 you need to consider, as far as, let me change all of this to blue. Blue is for explanation. Okay, additional points. All right then. So another point we need to consider is that absorption costing method considers overhead absorption costing, that is under or over absorbed overhead. Okay, absorption costing method consider, let me put it down, absorption costing method consider overhead absorption costing. Overhead absorption costing. That is under slash over absorption. Okay, that's another point you need to consider. Okay, that's another point you need to consider. So as far as, let me remove this one, I don't need it for now. As far as marginal costing, sorry, as far as absorption costing method is concerned, okay, when you are presenting your income statement, you must consider overhead absorption costing. That is, whether your overhead is under or over. So all of this, I will explain to you the concept of overhead absorption costing later on. So these are the key points you need to consider as far as absorption costing method is concerned. Okay, what are the formats you are supposed to use when you are presenting your income statement using the absorption costing method? Okay, what are the formats? The first thing you are going to do, just like you did under the marginal costing, is to determine your sales value. Just multiply the units sold, multiply by the selling price. Thereafter, you determine the production cost. Then, under production cost, the first item will be your opening stock. And this your opening stock should be valued at total cost per unit, direct material per unit, direct labor cost per unit, direct expenses per unit, variable production overhead, then fixed production overhead. You add the 5 of them together, that will give you your total cost per unit. So you then multiply with the opening stock in units. You come and post. Then your direct material cost will be the same thing as you have under the marginal costing approach. Just multiply the material cost per unit with the unit produced, actual unit produced, you post. Direct labor cost per unit multiplied by actual unit produced, you post. Direct expenses per unit multiplied by actual unit produced, you post. Then variable production overhead per unit multiplied by the unit produced for the period. Then you post. Not only that, remember, we said overhead is part of production cost. Overhead, okay, you multiply your fixed production, you post. Like in my explanation, all these things you have here, all the values that you have here in 2023, 2024, 2025, that's what we are going to post. That's what you are going to post under your fixed production overhead in this line. That's what you are going to put there. You multiply the actual unit together, that will give you the cost of goods available for sales. Immediately after the cost of goods available for sales, you have to consider closing stocks. You then go ahead and calculate your closing stock in units. You multiply with the total cost per unit. That will give you the value of your closing stock. The difference between cost of goods available for sales and the closing stock will give you the cost of goods sold. All right. So immediately after cost of goods sold, you must consider overhead absorption costing. You have to consider overhead absorption costing. Is your overhead under or over relative to the budgeted overheads? All right. So that's what we are going to discuss that later on. Okay. So if the overhead absorbed to products, if the overhead charged to products is lower than the budgeted overhead, that means it is under. If it is under, you are going to add. But if the overhead absorbed, the actual overhead absorbed to products, that is the overhead charged to products, if it is higher than the budgeted output, that is over absorption. If it is over absorption, you are going to less it. You are going to less it from the cost of goods sold. So the difference between your cost of goods sold and under or over absorption will give you this value. You then deduct that from your sales value to have your gross profit. Remember, earlier on, I told you that marginal costing technique uses contribution margin, whereas absorption costing uses gross profit. This is one of the features of absorption costing method. Absorption costing considers or uses gross profit, unlike marginal costing that uses the contribution margin. Nancy, talk to me.
I just wanted you to repeat what you were saying for the under and over.
Don't worry,
Absorption.
it's a concept on its own. I will explain later. Okay? Hold on first. We will soon get there. It's a concept on its own. So but let me just, in this particular area, what I'm saying is that if your budgeted overhead, the overhead you plan to incur, if it is higher than your actual overhead absorbed to the product, the overhead you charge to the product, that means it is under absorbed. So if it is under absorbed, if the overhead is under absorbed, so you are going to add it to your cost of goods sold. But if your who is that? Chairman Udeze. You are making noise in my class. So if the overhead absorbed to product, the overhead you charge to the product, if it is higher than the budgeted output, that means it is over. If it is over, you put it in brackets. Like I said, I will explain this in detail later on as we proceed. But for now, that's just a little explanation of that. Now, when you less this figure from the sales, you are going to have the gross profits. Okay? Immediately after gross profit, you must consider non-production costs. You have to consider non-production costs. This non-production cost will include both variable and fixed non-production costs. Any cost that the company will incur that does not relate to production will come under non-production cost. Under this, you can have variable selling and distribution expenses. You can have fixed selling and distribution expenses. You can have variable admin expenses. You can also have fixed admin expenses, marketing expenses, depreciation, factory manager, okay, factory manager salary. So any expenses that the company will incur, provided it's not related to production, will come under the non-production cost. All right. So you then add up everything together. You less it from your gross profit. Whatever you have thereafter represents your profit before tax. Then you need to calculate income tax. You only consider income tax if you are given tax rates in the question. In some instances, examiner will not give to you tax rates. In that case, you just ignore your income tax. So in that case, it simply means that your profit before tax and your net profit will be the same. All right, so that's that. So when you less income tax from the profit before tax, you can either have net profit or loss. Okay, you can either have net profit or loss. Okay, so that is for that. This is the format for presenting income statements using the absorption costing method. Okay, using the absorption costing method. All right, so the next thing we are going to discuss is how to calculate closing stock. It's not in this material. Let me include it for you. Estimating closing stock. Let me put it here. Let me put it here. Estimating closing stock, or how to calculate closing stock. Now, examiner will never, okay? Examiner will not give to you closing stock. It's your responsibility to be able to estimate the closing stock from the information provided in the question. Therefore, how do you calculate closing stock? Okay, let me use a format to do this. Let me present you with a format to do this. Let me see. Let me start the table. Let's say we are going to have let's say we have only one period. Let's say we have only one period, okay? Closing stock can be calculated using the formats or using the table below. So anytime you want to compute closing stock, if you like, you can use a formula. If you like, you can use this table. Whichever one you do, you are going to get the same answer. Okay. So let's say we have only one period. So first thing first, you need to calculate the closing stock in units. All right. When you are calculating closing stock in units, the first item will be opening stock. Let's say, for example, in 2023, you have a closing stock of 1,000 units. Okay, opening stock So let's say in 2023, you have a closing stock of 5,000 units. So as you are moving to 1st January, as you enter 1st January 2024, the closing stock at the end of 2023 will become opening stock. So here I would let me use figures instead of letter. So let me just put it like that. So let's say we have opening stock of 5,000 units. In 2023, we have actual units produced, actual production. So you are going to add actual production to the opening stock. Okay, let me make this opening stock to be let's say 2,000 units. Let's say it is 2,000 units. All right. So let me increase my table to make it 3, for example. Sorry, the column. Let me make the column to be 3. So in that case, I will include additional, I will insert additional column. So let's say this is 2023, 2024, 2025. Let's say we have 3 years in this particular question. These are our hypothetical figures. All right. So in this case, I want to determine where we want to calculate closing stock. So we're also using these hypothetical figures we have before as part of actual production for the year. So in 2023, actual production is 5,000 units. In 2024, 6,000. In 2025, is at 2,000 units. Okay. Now, all I need to do now is to determine my total unit available. When you add up opening stock plus actual unit produced, we give you the total unit available. Total units available for sales. This is the unit that the company is going to sell to customers in the market. Okay. All right. So here will be 7,000 units. Now, let's say, for example, we have units sold for the period. Units sold. Let's say in 2023, the company sold 6,000 units. All right. Then in 2024, let's say the company sold 5,000 units, for example. Then in 2025, let's say the company sold, let's say the company sold 3,000 units, just for simplicity. So at this point, I need to determine my closing stock in units. I would then say closing stock. Okay, closing stock in units. All right. So I will then come here. The total units available for sales in 2023 is 7,000. Out of the 7,000, the company sold 6,000. That means we have closing stock of 1,000 units. That's the closing stock at the end of 2023. In 2024, okay, in 2024, let's say, for example, of course, the closing stock in 2023 will become opening stock at the beginning of 2024. So here will be 1,000. So in that 2024, 6,000 units were produced. So 6,000 plus 1,000 will give us 7,000. Out of the 7,000 units available, the company sold 5,000. So that means we have closing stock of 2,000 units. As we are moving to the 1st of January 2025, the closing stock at the end of 2024 will become opening stock. So we have 2,000 here, 2,000 units. When you add it up, in that 2025, we also produced 2,000 units. That makes up 4,000. Out of this, the company sold 3,000. So we have a closing stock of 1,000. So this is how to calculate closing stock in units. Now, all I need to do now is to now determine the valuation or the value of my opening stock. I will then come here, valuation. I want to value my closing stock. To do this, I'm going to using the two methods. The first method that we discussed earlier is marginal costing approach. Under the marginal costing approach, remember we said that for valuation, it is to get the value of your closing stock, it will be units. It will be number of units unsold, unit unsold, multiplied by cost per unit. Cost per unit. So in this case, under marginal costing approach, I will pick in 2023, for example. In 2023, for example, I will pick 1,000 units. 1,000 units multiplied by total variable cost per unit. Let's say total variable cost per unit based on our hypothetical figures we had earlier on. Let's say it's 12 naira. Therefore, in 2023, our closing stock would then be 12,000 naira. That's for 2023. 2023. That's the closing stock in 2023. Under the absorption costing method, ACA, this will be equal to the same 1,000 units. All right. Then multiply by total cost per unit. Remember, under absorption costing method, opening and closing stock are valued at total cost per unit. In our hypothetical figures that we used earlier on, total cost is 15 naira. Let me show you. This is it. This is total cost, 15 naira. Total variable cost, we had 12 naira. When you add up direct material, direct labor, direct expenses, variable overhead, that's 12 naira. So that's the hypothetical figures we are using here. All right. So then multiply with 15 naira here. So that will give you 15,000 naira. So in my formats, I'm going to do I'll do example for 2023 alone because of time. Now, in my format, under the closing stock for here, under absorption, here you are going to put 15,000 naira. Under the marginal costing approach, for my closing stock here, I will put 12,000 naira. So this is how to value closing stock. This is how to value closing stock. Let me put it in blue so that it will be different from the existing notes. Okay, I believe this is clear. Now, the next thing we are going to discuss is the concept of overhead costing. We have two areas to discuss before we begin calculation. All right, so let's talk about overhead absorption costing. All right, let me see. Let me remove this one for, okay, let me just leave it. Overhead absorption costing. Pay attention to this. This particular one relates to absorption costing method. All right, so you need to pay attention. For some of you that have done foundation, you'll be familiar with this information I want to dish out. All right then. So, what do you mean by overhead costing? Because of time, let me just put it down. Or let me do a kind of a brief explanation of that. Now, when you talk about overhead costing represents the process of allocating indirect costs, including rents, utilities, right? Depreciation of factory assets, rates, the rent of the factory building, all the expenses that the company will incur in the factory, all those expenses, all those the fixed costs or the indirect costs that the company will incur in the factory. So the process of allocating them to a product or service is what is known as overhead costing. When you want to determine the unit cost of a product, but under absorption costing, you consider fixed production overhead. So overhead is the same thing as indirect cost. All those costs that are not variable in nature, all right, they are the indirect costs. They are the overheads. So like the factory building, the rent of the building is an overhead cost. For production, it's also overheads. The utilities that the company will incur in running the factory is also part of the overhead cost. The rent and the rates that the company is going to incur is part of the overheads. So any expenses that the company incur in the running of the factory, okay, in the running of the factory is called overheads. Now, these overheads that the company will incur is expected to be charged to the products. Therefore, and that's why we are saying that overhead, let me just put it down. This represents the process of allocating indirect costs, including rents, utilities, factory manager's salary, depreciation, rents, okay, rates, etc. Any expenses that the company will incur. Okay, the process of allocating them to a product, or service. That is indirect, that is the overhead costing. Overhead costing is the process of allocating, the process of charging indirect costs, such as depreciation, factory manager salaries, okay, rent and rates, utilities. The process of charging them to a product or service is what is known as indirect cost. Ordinarily, the overhead absorbed, the overheads overhead, okay, the overhead absorbed absorbed to a product or service should equate the budgeted overheads. Should equate budgeted overhead. This will mean that when this happens, it means the overhead, let me shorten it. The overhead is appropriately absorbed. It means that the overhead is appropriately absorbed. However, when the budgeted overhead is different from the overheads absorbed to a product or service budgeted. However, when the budgeted overhead is different from the overhead absorbed to a product or service, this will result in under or over absorbed overhead. Okay, this will result in under or over absorbed overhead. When under this circumstance, okay, I will give you that one later on. So this is simply what we mean by overhead absorption costing. This is what we simply mean by overhead absorption costing. So just as a recap, the overhead absorption costing means represent the process of allocating indirect cost. That is the process of allocating overheads to a product or service. And then ordinarily the overhead charged to a product supposed to equal the overhead, the budgeted overheads. However, if the budgeted overhead and the overhead absorbed to a product is different, it will result to either under or over absorbed overheads. So ordinarily, the difference should be adjusted from the cost of goods sold, but I don't want to write it down now. But let's talk about what do you understand by under absorption? What do you understand by under or over absorption? So let's talk about it. Yes, Joy, talk to me. Joy?
Okay, sir, can you hear me?
Yes, go ahead.
Okay, I think I got lost from the table you gave for opening stock and then the explanation on absorption, overhead absorption. Sorry.
You do what? You get lost from where?
From the table, the explanation of the closing stock.
Closing stock.
Yeah.
Okay. I wanted to suggest before that you watch the video, but let me just give you that benefit because it should be a disservice to. I've left that position about 5-10 minutes ago. let me just explain briefly. What we are saying is that if you want to value your closing stock, first thing first, you must determine the closing stock in units. So to get the closing stock in units, you are supposed to add opening and closing stock together. You had opening and closing stock in unit together. Sorry, opening stock in units, you had it with the actual unit produced. So that will give you your total units available for sales. This total unit available, it is from the total unit available you are going to make the sales. So any unit that you sold, any unit sold, all right, should be deducted from the total unit available. So the difference will give you the closing stock. So I will only explain for 1 year. It's the same procedure, all right? So if you now want to determine the closing stock, for example, in 2023, I want to determine the value of the closing stock. Closing stock in 2023 is 1,000 units. So if I want to value this closing stock of 1,000 units, under marginal costing approach, I will pick the 1,000 units I have in 2023. I will then multiply with the total variable cost per unit. This 12 naira that you have here is the hypothetical figures we have before when I was explaining the marginal costing approach. All these numbers that I put here, direct material, direct labor, direct expenses, variable overhead, when you add it together, it will give you 12. If you add 3 to it, it will give you 15. So because we are using marginal costing approach, so the closing stock of 1,000 units should be multiplied with 12 naira. That is what gave us this 12,000 naira. So this is the value, this 12,000 naira is the value of the closing stock we are going to use in our format, in our table for marginal costing approach. That is, this place where you have closing stock, you go and do the working, like the 12,000 naira we have, I will then come and post 12,000 here. That's what we are going to do under the marginal costing approach. Then under the assumption costing approach, it's still the same thing. The closing stock of 1,000 units that we have in 2023, I will multiply it with the total cost per unit of 15 naira, like we have in our hypothetical figures. So that will give us 15,000. I will then go up in my table for absorption costing method where I have closing stock. I will post the 15,000 naira here. That is how to value closing stock. If you now want to do for the subsequent years, for example, in 2024, the closing stock of 1,000 in 2023 will become opening stock at the beginning of 2024. Then you had the actual unit produced in 2024. That will give you 7,000. The less the unit sold of 5,000, that will give you a closing stock of 2,000 units in 2024. So in that 2024, if you want to value, you then put 2,000 units multiplied by 12 naira. That will give you 24,000. Then again, under absorption costing, 2,000 units multiplied by 15 naira. That will give you 30,000. So that's how you are going to value the closing stock. Is it clear now, Joy?
Yes, sir. Thank you very much. It's clear.
You are
Thank you
welcome.
very much.
You are welcome. So we then move to overhead absorption costing. We said that overhead absorption costing is the process of allocating indirect cost to a product or service. Okay, so if the actual overhead absorbed to a product or service is the same thing as the budgeted overhead, it means that the overhead is appropriately or rightly absorbed. But if the budgeted overhead is different from the overhead absorbed to a product, it will result in under or over absorbed overheads. So, and I was trying to explain what is under absorption, what is over absorption. How do you treat under absorption? How do you treat over absorption? So that's the next thing we want to discuss now. Now, what do you mean by under absorption? This arises. Okay, I think I have it here. Let me see. That's this. Okay, let me just. This arises when the budgeted overhead, or output is higher than the overhead absorbed abs- absorbed to a product, or service. Okay, this arises when the budgeted overhead or output is higher than the overhead absorbed to a product. All right. This means that the cost of goods sold, or let me put it this way, when this happens, the cost of goods sold will be higher. The cost of goods sold will be higher, or the cost of goods sold will be overstated. And the profits will be underreported. Under this circumstance, the difference should be added to the cost of goods sold. So that is how to add it to the cost of goods sold to reflect the planned figures, the planned estimates. All right. Overstated. All right, so that's what you need to do. Oh, I wrote double this. So that's what you are going to do as far as absorption costing is concerned. So let me explain this further so that you can understand better. The difference should be added. Let me add it to cost of goods sold. Let me bold it. Now, let me explain this further for you. For example, I hope I'm going to finish all the explanation today before our time expires, so that in our next class, we'll be doing calculation straight. So you also have something to read between now and when next we are going to meet. Let's say, for example, we have budgeted overhead. We are given budgeted overhead. We are given budgeted overhead of 40,000 naira. Okay? We are given budgeted overhead of 40,000 naira. Let's say the overhead absorbed to a product is as in our first example, in the explanation I did earlier on. Where did I have fixed overhead? I think I did fixed overhead. Yes, this is fixed overhead. Okay, let me just use a different figure. Where is that? Okay. Let me use a different figure. So let's say, for example, we have given budgeted overhead of 40,000. So we are now given also fixed production overhead. Fixed production overhead. We are given fixed production overhead. In 2023 to be equal to, let's say, 35,000 naira. Okay, 35,000 naira. Then in 2024, you are given fixed production overhead to be 40,000. In 2025, let's say we have fixed production overhead to be 50,000 for simplicity. Okay, so these are the information given in the question. Okay, these are the information given in the question. So if I now want to determine whether my overhead is under or over, okay, maybe this should even come. Maybe I should give this example. Okay, I will use one that relates to nation in this example. All right, let me blur this so that I don't forget to make it different from the old one. Okay, now this is what we are saying. Ordinarily, the overhead that the company is going to charge to a product should be the same thing with what they budgeted for. But in most cases, the actual overhead absorbed to a product will be different from what is budgeted for. Let's say, for example, in 2023, the actual overhead absorbed to a product is 35,000 naira. Meanwhile, the budgeted overhead is 40,000. This is what the company plans to incur. This 40,000 naira will represent the rents, the utilities, the rates, the depreciation, all the overheads that will be incurred, that the company plans to incur is 40,000 naira. So what the company plans to incur is 40,000, but what the company charged to a product is 35,000 naira. So it means that what this company absorbed to it, what the company charged to a product of 35,000 is lower than what the company budgeted to incur, budgeted to charge to a product. So in this case, it is under what the company is charged to a product. The overhead the company charged to a product is less than what the company budgeted to incur. This is called under assumption. So if your overhead is understated, if your overhead is understated, this is not right. This is understated. This should be understated. Yeah. So if your overhead is understated, it means that your cost of goods sold is understated because you are supposed to charge this and you are charging this. So if your overhead is understated, it means that you are over-reporting your profits. It means that your profit is over-reported. Okay, this is over. The profit is over. The profit will be over-reported. So you are reporting more profits. So if you report more profits, that means you are going to pay more tax. That's the implication. So anytime that you discover that the overhead you charge to a product is less than the overhead the company budgeted to incur, it means that it is under absorption. It means that the overhead is under absorbed to a product. So when that happens, the difference between this 40,000 and 35,000, which is 5,000, should be added to the cost of goods sold. Should be added to the cost of goods sold. So to reflect the actual plan to reflect the 40,000 we plan to incur. So that's how you are going to treat under absorption. So let's talk about over absorption. Over absorption. Okay. This occurs when the budgeted output or overhead, when the budgeted output or overhead is lower than the overheads absorbed to a product or service. To a product or service. When this happens, the cost of goods sold will be overstated. The cost of goods sold will be overstated, and profits will be underreported. Profit will be underreported because you are supposed to charge higher, then you charge lower. Sorry, you're supposed to charge lower, you charge higher to your product. That means you are underreporting. You have charged more expenses. You have charged more expenses. If your expenses is higher, your profit will be lower. All right, that's the implication. All right. So under this situation, the difference between the budgeted overhead and the overhead absorbed to a product should be deducted. The difference should be deducted from the cost of goods sold. From the cost of goods sold. That's the treatment of over assumption. Should be deducted from cost of goods sold to reflect the actual plan. Okay, so this is over. Let me explain this. From this, our hypothetical figures, right? We budgeted to incur 40,000. But when you look at 2025, when you look at overhead in 2025, this is the overhead charge to a product in 2025. Instead of the company to charge 40,000 to this product, the company charge 50,000. That means you have over-reported your cost of goods sold. All right, you have over-reported your cost of goods sold. If you over-report your cost of goods sold, your profit will be lower because your expenses will go up and your profit will be lower. So in order to correct this, the difference between that 40,000 naira, the difference between this budgeted overhead of 40,000 and the actual overhead absorbed to a product, which is 10,000 naira, should be deducted from cost of goods sold. That is the implication. That's what you have here. That's how you are going to treat over absorptions. Okay. Now, on the day of your exam, if you have question under marginal costing, under marginal absorption, examiner will not tell you to calculate over absorption or under absorption. No, it is implied in the question. The information given to you will tell you the direction that you should follow. All right. The information there in the question will tell you the direction that you should follow. Okay. So that is basically how to treat under and over absorption costing. Okay. Let me color this one as blue. Now, the last area we are going to discuss will then be reconciliation statement or variance analysis. Let me see if there's any information here. In this case, the under absorb. Okay, I don't need this one. I've already explained that. So this one is not needed again. All right. So now, in case in the question, you are not given fixed overhead absorption rate, that is your fixed cost per unit. If you are not given your fixed cost per unit, it is calculated as fixed production overhead divided by the budgeted output. That will give you your fixed cost per unit. Okay, you go to the question, you pick the fixed overhead absorption, you pick the fixed production overhead as given to you. You divide it by the budgeted output, or you call it normal capacity, whatever it is. You get your fixed production, your fixed overhead absorption rate. You then multiply with the actual unit produced for each year. So that will give you the fixed production overhead for each year. All right. Also, it is possible that when you are determining your under or over assumption, it is possible that examiner may not, you may not be given the overhead in naira. So that means you are given overhead in units. If you are given overhead in units, the first thing you are going to do is to determine the under or over in units. You then multiply each of them with the fixed overhead absorption rates. So it will give you the overhead cost. Okay, it will give you the overhead cost that you are going to consider, that you are going to use under the under over absorption. So we are going to have an example to demonstrate that as we proceed, but not today. Okay. So let's move on from here. Let me adjust this one. All right then. So let's talk about reconciliation statement, and this is where we are going to call it today. Now, in most cases, except by coincidence, in most cases, the income statement prepared using marginal costing approach and absorption costing approach will not produce the same results. The net profits under marginal costing approach and the net profits or loss under the absorption costing approach will be different, except by accident or by coincidence. They will never be the same. Therefore, what is causing the difference? So examiner can ask you to explain why the operating results under marginal and absorption costing method are different. So this is what you are going to be talking about. The first thing you are going to say is that the income statement prepared using marginal costing approach will produce a conflicting result with the absorption costing method. Why? This is because different methods are used to value stock. Under the marginal costing approach, opening and closing stocks are valued using total variable cost per unit. Whereas under the absorption costing method, opening and closing stocks are valued at total cost per unit. Therefore, the difference, the delta or the variance between the profit of the two techniques should be reconciled using the reconciliation statement. All right. So how do you then prepare your reconciliation statement? There's a format that you're supposed to use. At all time, when you want to prepare your reconciliation statement, you have to use profit before tax. You don't consider net profits. You only use net profits if in the question you don't have income tax, which means that your profit before tax and your net profit will be the same. So, but if in the question you are given income tax, so you cannot use net profit for determining your or to prepare your reconciliation statement. It has to be profit before tax. So you then go to the question, you go to your solution under your income statement for absorption costing. Under the, let me start with the marginal, or let me start with the absorption. Under the absorption costing, this profit before tax that you have here, whatever the value, you come and put it there. That's what you are going to put here. You have to start with the ACA, assumption costing approach first, or your assumption costing method, whatever you have used. Then you go to the income statement prepared using marginal costing approach. Go and pick the profit before tax you have there. So you then less. The difference between the two will give you the difference in profits. This will give you difference in profit. The objective of this reconciliation statement is that the difference in profits and difference in stock valuation should be equal. So after you have determined the difference in profits, the next thing you are going to do is to determine difference in stock valuation. You need to find difference in stock valuation. To do this, you are going to pick closing stock. Closing stock for absorption costing. You go to your table under your income statement. What do you have there as your closing stock? You pick the figure, come and post. Under the marginal costing, you go there and pick the figure for for closing stock. You then find the difference between the two. It will give you difference in closing stock. Once you have find difference in closing stock, you also find difference in opening stock. You go to assumption costing method. You pick the opening stock that you have there, if any. You go to marginal costing approach. Go and pick the opening stock the value of the opening stock you have there. If there's anyone, all right. Where you don't have any, just put dash, put 0 there. 0 minus 0 will give you 0, whatever it is. So the difference between the between the opening stock, the difference between these two, you then deduct it from the difference in closing stock. So the difference between this and this will give you difference in stock valuation. So at all time, difference in profits must be equal to difference in stock valuation. If A is equal to B, it means that what you have done is perfectly okay. This is self-review kind of question on the day of your exam. Because if you prepare your reconciliation statement and the difference in profits equals to difference in stock valuation, it means that all what you have done is correct. So you are rest assured that you have 20 or 15 marks in your pocket. So this is what you need to do. And then this is where we are going to call it a day. So these are all the explanations that relate to operating statement. Of course, you can do more. You need to read about advantages and disadvantages of each method. What are the advantages of marginal costing approach? What are the advantages of absorption costing approach? All of these are in your notes. So you can always read them through. All right. You can always read them through. Okay, then. So let me know if you have any question for me. This is where we are going to call it a day. All right. This is where we are going to call it a day. Any question for me? Let me see. Some of you have disappeared. About 15 of you have disappeared, but I still have good ones available supporting me here. Let me check those of you online with me. Yes, Daniel Uko he has disappeared also. So Daniel is on. Antonin is still on with me. Chioma Ofobeze. Then I also have Chioma Udeze. Ezine Obaze. Frances. Frank Wisdom. Gabriel Chisholm. Ansin Ame. Ijem, I greet you. You are still here. Ikechukwu. Joy, Judith, Lovett, Muibat, Nancy. Okay, I still have Peace. Peace is here with me. Okechukwu, Sandra Eze, Shola Atimiri. Then I have, of course, Daniel, then Zoom user. Thank you all of you for waiting behind to the last minute.
So I don't know my name.
Thank you, sir.
Sorry about that. Remind
My name is
me.
Vera.
Oh yeah, Chizaram. Chizaram. Sorry, I didn't say that. Skipped me. I'm really sorry. Not intentional. All right. So, thank you, every one of you, and for waiting behind. By the grace of God, we are going to meet again next week, Friday, when we shall complete this topic. Then I'm going to introduce relevant costs for decision making on that day. All right. And please, I beg of you, as you can see, your note is accumulating now. Your note is accumulating. You had a class on Tuesday. Today is another one. Before you know it, it's building up. Before you know it, to become a burden on you if you don't read your books. So please, like I advised you on Monday, and by now I will expect that you would have done it. You are expected to schedule your reading timetable Monday to Sunday, because you cannot be reading anyhow. You can't be reading randomly. You have to schedule your reading timetable, and you have to be committed to it jealously. If you say you are going to read a particular subject on Monday, for example, you must ensure you do it. Don't skip it. Don't accumulate notes without reading them, because it's going to affect you. It will tell on you by the time you are getting by the time the exam is it's approaching. And that's why it is important for you to start early. Early preparation is key to your success on the day of your exam. So please don't disappoint us. All eyes are on you. We are looking up to you, that you are going to succeed on that day, that you are going to make us proud, because we cannot write the exam on your behalf. You are our ambassador at Equity. You are Equity ambassador. And that's why we are going to do our best. You can't get anything less than the best that you deserve, because you have paid for it. Not only that, because we want to contribute to your success story. And that's why it is important for you to read, because no matter how we try, no matter how your lecturers tried in the class by giving you the best, if you don't read them, if you don't practice them, you can't do well. You can't know much. Competence is something you derive, you derive from constant practicing. For you to be able to be competent in that particular task, it has to be something you are doing over and over again. It does not become part of you. Confidence is a function of experience. If you really want to express yourself freely on the day of your exam, you have to build that confidence naturally. Confidence will only come from experience, because if you have practiced, you have read wide, okay, and you are given questions, you'll be very happy with yourself. But if you are dilly-dallying, if you are nonchalant, it's going to affect you. It will affect your success on that day. It will affect your performance, and you have to avoid that. You have to avoid consequential effect of failure. That will never be your portion. Please, ICAN exam is not difficult. I have passed through it. So many thousands of students like you in the past have passed through it, and they succeeded. You can do better. Students are winning prizes. You can do it. You can do better. It's all about you. It's all about you. Please, don't limit yourself to what you have in the class alone. Get exposed to other materials. You have to use other material. You have to use the class study material in conjunction with the ICAN study pack and other relevant material like Golden Book. In your performance management, you are going to need the performance management Golden Book. Highly simplified notes. Highly simplified. It's almost 700 pages a book. Please, start reading now. Start reading now. It's very important. May God guide you aright. So, my people, this is where we are going to call it a day. We'll meet again next week, Friday, by the grace of God. Good night to you, everyone.
Good night, sir.
Thank
Good night, sir.
Good night.
Good night, sir.
you.
Good night, everyone.
Good night.
Yeah, Joy, good night. Okay. Stop recording.